And Kenny, the possibility of Alberta's producers having to pay customers to take oil off their hands. This part of the continued fallout tied to COVID-19 and the ongoing price battle involving Saudi Arabia and Russia. And now we have seen leaders from this country's energy industry write an open letter to Ottawa with their desire for more assistance from the federal government. Kevin Neveu is the CEO of Precision Drilling and is one of the authors of that letter. And Kevin joins us now with more on that part of the story. Thanks for being with us. Really appreciate it.
Good morning, John.
Let's start with the letter and the main concerns that you and others in the industry have right now, Kevin.
John, we're really trying to communicate to Canadians generally just how impactful the oil service sector is in job creation and as an economic driver in Canada, not just Western Canada, but across Canada. So the letter references, a couple 100,000 jobs already that have been at risk over the last few years. And as we look at this downturn right now, I can tell you that, for example, drilling activity today versus a year ago, is just a little bit about a third of a year ago. Now we're in spring breakup, which is typically a slower period, but nonetheless, we're still running at kind of all-time lows and activity running today that's about a third of what we saw last year. So it's a very dire situation. And, especially for our workers, if you think about each drilling rig in Western Canada supporting about 40 jobs for the drilling contractor, and then about another 150 jobs for the supporting community, including restaurants and hotels and food services and supply services for those rigs. There's a huge follow-on impact to the reduced activity, all driven by the low commodity price.
And we're trying to figure out ways by which we can stem the bleeding. One of the things that you and other leaders talked about was the idea of seeing Ottawa assist with paying off accounts receivable. I don't want to get too technical, Kevin, but why did you as leaders key in on that?
I think what we're trying to do is to come up with ideas that would be commercial in nature and not bailout or handout asking for something. So the concept of what's called factoring receivables, in fact, selling your receivables asset to a lender, is a pretty common tactic used in times of liquidity tightening. And we felt that was a way that the banks like EDC or BDC, federal government banks, could inject liquidity, but do it in a commercial fashion, not in a bailout fashion. We think there's other things they can consider also that we've been mentioning to the government, things like even purchasing back future tax credits, where we have tax credits we've earned over the last few years that we won't use until we're profitable. The government could buy those back from us and monetize those. And that's, again, it's a commercial transaction rather than a bailout.
So a number of ideas on the table, and we know that the federal government has addressed Alberta's challenges in the energy industry specifically. But at the end of the day, when it comes to getting assistance, do you feel like you have Ottawa's support?
I think it's tough for the federal government right now. I think there's a lot of priorities pulled in different directions. Certainly, our industry isn't the only industry that needs some sort of support. Lots of industries are facing the same challenges, from the restaurant and entertainment industry to the airline industry. So we understand that. But the government needs to move quickly. It's certainly a dire situation for us and for other industries. So we just can't wait much longer. This reminds me a lot of the early 1980s when the oil service sector in Canada was decimated. And it took the industry over a decade to recover from that. And certainly, tens of thousands, hundreds of thousands of jobs were lost back then and never replaced. And we see that same imminent risk right now.
Maybe we can tell the current story through your own business. Obviously, you're here talking in part representing the industry, but you guys have a publicly traded stock, which, as you know, is now below $1. And I think, your market value has declined by about $1 billion or so over the last year. And when you say things like cost cutting, can you give us a sense on what you're grappling with every day? I know you've already laid out some of your cost-cutting measures, but how many jobs at your business are on the line right now?
I think the numbers I can give you are actually shocking in that back in February, when we had 80 rigs running in Canada, we had about 2,000, a little over 2,000 employees working for Precision between field locations and our offices. We expect to be down below 400, probably below 350 by mid Q2. So by mid-May, we expect that headcount to likely go from around 2,000 down to about 350. Now, the vast majority of that are field jobs. Those are rig workers as the rig counts come down. But that's still probably less than half of what we were expecting. We would have thought we'd be closer to 1,000 with normal seasonality. So this is a deep decline. Those are all, high quality career-based jobs that pay quite well. There's large income tax payments made by those employees too. So the impact that this is going to play out is going to be much more than just Precision. It'll play out across the economy. And you have to realize that, if we had, for example, 20 or 30 more rigs running, that's probably another 100 to 150 hotel beds we'd be renting from hotels. It's, it's 3 times that many meals per day from restaurants in the field and things like that. So I think the impact goes well beyond just Precision. But in our case, we feel we're taking the steps necessary. We've announced a number of cost-cutting measures, both in our corporate office and with our board. Unfortunately, some headcount reductions and some reduced work weeks. I think we're doing all the things we need to do to batten down the hatches for Precision. But the industry on the whole is really at risk. And I think that there are many smaller contractors that, maybe need the help a little sooner. Certainly in our case, we think we'll weather the storm indefinitely.
Before we let you go, Kevin, I do have to get your reaction to those comments from the Premier when he talked about preparing for the possibility of negative oil prices in this country. I mean, we've already watched the prices for Alberta oil come down from, I want to say, the $60 level to below $4 in trading yesterday. But you work in this industry. How realistic do you think it is that we could be, in the not too distant future, talking about negative oil prices in this country?
Well, that's actually already happened in a few places, not in Canada, but in the northern U.S., where pipelines are at capacity and any additional oil coming on, people are paying to have it shipped. So it's happened a couple of times already. So, the possibility is real, it's imminent, and I think for Canada it's a big concern. You have to remember that we came into this COVID-19 epidemic and then the commodity price war between OPEC and Russia. We came into this as a Canadian industry that was already in stress or maybe even distress. We've been through almost a half a decade of reduced WCS pricing, cost cutting across our industry, headcount reductions, reduced drilling activity, reduced investment. So we came into this downturn, this sharp downturn, far less prepared than we would like to have been.
Lots to think about, and it is good to get your perspective despite the uncertainty right now, Kevin. Thanks a lot. I hope you and your team stay healthy and safe in these challenging times.
Great. Thank you.
That's Kevin Neveu, the President and CEO of Precision